The supply chain just vetoed the paper silver market, and the proof is showing up in the cargo bay. Not in a press release, not in a glossy investor deck. In the kind of decision nobody makes unless the math has turned ugly, paying to move heavy metal fast by air because waiting costs more than flying. And that's where the real pressure starts, because silver isn't supposed to fly, it's not gold. Gold is high value in a small package. Air freight is normal. Silver is value spread across weight, across pallets, across time. If you hear cargo flights for silver circulating through trade desks, refiners, and logistics channels, that's not a fun anecdote. It's a symptom that the link between paper and physical is stretching, and once that link stretches far enough, price discovery stops being polite. But that's not the part that matters. The part that matters is what has to break for air freight to become rational. And once you understand that, you'll know exactly what to watch over the next week or two, which level matters, what confirms the squeeze risk, and what invalidates it, even if the chart still looks pretty. Because if this one mechanism stays stressed into early January, the math changes. Let's anchor the tape first, because the tape is what everyone argues about. Silver has been whipping around hard. We have seen it push up into the mid-80s in the recent run, and then snap back into the mid-70s during the same year-end window, where liquidity thins and margin pressure gets unforgiving. That kind of move rattles people. It creates the illusion that the story is over, or the illusion that the story is just beginning. Both can be wrong at the same time. And that's where the trap is. The market loves to weaponize that confusion. A fast spike convinces late buyers they missed it. A sharp drop convinces early buyers they were fools. Then price returns to the stress point and forces everyone to make the same decision again, but with less confidence. That's not a conspiracy. That's how leveraged markets prune weak hands. And silver, more than almost anything, is a leverage amplifier. Here is the hidden detail you were not hearing cleanly on mainstream screens. Silver is not one market. It's a chain of markets that only look unified when transport, financing, vault capacity, and deliverability are working smoothly. When those gears grind, the spot price becomes a headline number and the real signal migrates into spreads, location premiums, borrowing costs, and the urgency of procurement. Everyone watches the headline, but the signal is somewhere else. Think of silver like electricity across a grid. You can quote a national average price, but if one region's transformers are overloaded, the price that matters is the one at the node where the wires are hot. In metals, those nodes are the hubs, futures delivery mechanisms, OTC vault ecosystems, and the regions with real physical pull. And when the grid is calm, arbitrage keeps everything aligned. When it's stressed, you can have plenty of metal on paper and still have a shortage of metal that can actually be moved, financed, and delivered in time. And that's the shortage nobody wants to say out loud. Now let's talk about why cargo flight is such a loud clue. In normal conditions, moving silver is slow, optimized, and boring. It rides ships, it rides trucks, it sits in vaults, it moves on schedules. Silver is an industrial metal and a monetary metal at the same time, which means it has real-world utility and real-world frictions. See, refining capacity matters. Fabrication, lead, times matter. Bar specifications matter. Insurance matters. Customs matters. Those are not vibes. Those are constraints. Air freight is expensive. Not just the plane, the security, the handling, the insurance, the chain of custody. You don't choose that option unless the alternative, waiting, is even more expensive. So what makes waiting expensive? A spread that's paying you to have silver now instead of later. A premium in one hub that can't be met quickly from another hub. A delivery clock that's ticking. A financing or borrowing cost that's climbing day by day. And when those pressures stack, air freight becomes the ugly, rational choice. But that's not the part that matters. The part that matters is what that implies about arbitrage. Arbitrage is the sacred glue in commodity markets. Buy in one place, sell in another, move the material, pocket the difference. In textbooks, it's frictionless. In real life, it's a relay race where every handoff can fail. Here's the clean version. If silver is cheap in Hub A and expensive in Hub B, traders should buy in Hub A, move it, and sell in Hub B, and the prices should converge. That's the story everyone tells themselves when they want to dismiss physical stress. If there's a shortage, price would just go up. But in a world with delivery constraints, not all silver is interchangeable. Not all bars qualify. Not all inventory is available. Not all supply can be mobilized quickly. And not all buyers can wait. So when a premium opens up and stays open, it's often because something in that relay race is broken. The wrong bar type, the wrong location, the wrong ownership status, the wrong financing, the wrong timing. The next detail is what flips the whole setup. Ownership status. That's the quiet monster. When you see big inventory totals quoted in certain regions, it's easy to assume supply is abundant. But inventory can be encumbered. It can be allocated to someone who isn't selling. It can be pledged as collateral. It can be leased out. It can belong to a fund that won to release it at any price that S reasonable in the short term. It can be there and still not be there. That is the difference between stock and float. In stressed markets, what matters isn't total stock. It's the free float, the metal that is both deliverable and willing. And the free float can shrink fast without any dramatic headlines. Now add deliverability categories. In futures-linked ecosystems, there are buckets of metal that are eligible to sit in a system and metal that is actually registered, prepared, and committed for delivery against a contract. People love to talk about these categories as if they're purely administrative. They're not. They're behavioral. The moment you need metal now, the relevant bucket is the one that can actually be delivered without someone choosing to convert, move, or release it. And conversion is a choice. It has costs. It has time. It has incentives. So when you hear someone say there's plenty of inventory, your first question shouldn't be how many ounces exist. Your first question should be how much is deliverable on the margin this week at this hub in the form buyers need? Because that's where price breaks first. And if you're watching silver like a macro asset, here's what makes this moment especially combustible. The calendar. The calendar is the catalyst. Year end and the turn into January are not normal time. Liquidity thins. Desk risk limits get tighter. Funds rebalance. Dealers reduce inventory appetite. The tolerance for carry and for uncertainty shrinks. Meanwhile, the physical world doesn't care about your accounting calendar. Industrial users still need metal. Refiners still have lead times. Logistics still have bottlenecks. And delivery windows still matter. That's why these stresses often show up when the screens are least able to absorb them. This is why you can see a blow-off high and a brutal dip in the same breath. It's not proof the thesis died. It's proof that leverage got repriced. But that's not the part that matters. The part that matters is what margin does in a metal that's traded with leverage. When volatility rises, exchanges often raise margin requirements. That means anyone holding futures exposure needs to post more cash immediately, not later. Now, and if they can't, they reduce positions. They sell what they can, they liquidate. That can slam price even if the underlying physical market is tight. You get these air pockets, you get these violent flushes. And if you don't understand that mechanism, you mistake forced selling for fundamental relief. It is like watching a crowded theater and assuming the person who tripped is the reason everyone is running. No, they tripped because the exit got narrow. The exit got narrow because risk limits and margins tightened. That's the difference between signal and noise. Now let yes stack evidence the way you need to if you're dealing with a skeptical audience. One argument doesn't cut it. Silver is too political, too emotional, too memed. So we're going to stack layers: market structure, physical symptom, institutional behavior, global comparison, and the calendar trigger. And then we'll build the next 2 weeks roadmap. Because if this one level breaks, the math changes. First layer: term structure and urgency. In commodities, the curve tells you whether the market is paying you to hold inventory or punishing you for it. When near-term pricing is strong relative to later pricing, when the market effectively pays for immediacy, that's a classic stress signal. It means now is scarce relative to later. It means the system is pulling supply forward. Even without quoting exact numbers, you can watch for it in how front-month contracts behave versus deferred months, and in how roll costs feel to participants. If front-month strength persists into a thin liquidity window, that's pressure. Second layer: inventory headlines versus usable inventory. Big vault totals can coexist with tightness if the metal is tied up. In London, for example, the ecosystem is huge in gross terms, but gross doesn't equal mobile. Funds, ETFs, long-term holders, those inventories don't necessarily come to market just because price moved. In a stress episode, the question is not, is there silver, but is there silver for delivery at a price that clears today? If you see persistent premiums or anecdotes about sourcing difficulty while totals look stable, that's a mismatch. And mismatches are where squeezes begin. Third layer: global pull. When Asia is bidding aggressively for physical, it creates a gravitational force. If inventories tied to Asian exchanges are reportedly drawing down to multi-year lows, or if premiums in that region stay elevated, that matters, because it's real demand for metal, not just paper positioning. That demand doesn't care about your futures narrative. It cares about securing supply. And once a region becomes the marginal buyer that won't wait, it can pull metal across the world. But that's not the part that matters. The part that matters is what happens when that pull meets logistics and fabrication reality. Silver is not just sitting as generic bars. It's being refined, turned into products used in electronics, solar, industrial applications. Supply chain lead times aren't infinite, and silver often comes as a byproduct of other mining, which makes supply less responsive to price spikes in the short term. You can don't just snap your fingers and produce more refined silver next week because price went up this week. That's why tightness can persist longer than the screen addicts expect. Fourth layer: borrowing cost, the market's truth serum. When metal gets scarce in the lending sense, borrowing costs can rise. Call them lease rates, borrow rates, availability rates, whatever label your desk uses. The concept is simple. If it's easy to borrow silver, the cost is low. If it's hard, the cost rises. That cost matters because it changes behavior. It turns a short position from a chart bet into a financing problem. It pressures market makers who rely on borrowing to hedge. It can force covering not because someone changed their mind, but because the balance sheet math stops working. Forced behavior is where real moves come from. The fifth layer, the street symptom, logistics urgency. This is where the cargo flights chatter lives. If the arbitrage spread is wide enough, someone will pay for speed. That alone doesn't prove a permanent shortage, but it proves a localized shortage of deliverable metal in a time-sensitive window. And localized shortages are how global shortages begin, because they trigger hoarding and defensive procurement. Once buyers stop trusting replenishment, they bring demand forward. They overorder. They lock in supply. That creates a self-reinforcing loop, reflexivity. But that's not the part that matters. The part that matters is how the paper market interacts with this. Futures markets are not evil. They are tools. They are how risk gets warehoused. They're how hedgers and speculators meet. But futures are also leveraged, which makes them prone to mechanical events. In silver, the paper layer can dominate the day-to-day print, while the physical layer can dominate the multi-week reality. That is why you can see price slam down on a margin event while premiums remain sticky. It's why you can see a spot behave like a risk asset while physical behaves like a supply chain. Now, add one more time-sensitive ingredient, policy and trade flow uncertainty. There has been recent chatter and reporting that certain export rules on metals, particularly from major refining and production regions, could tighten around the turn of the year. If restrictions or licensing requirements begin around January 1st, even the perception of tighter flows can front-load demand. Buyers do not wait politely for clarity. They secure supply. Traders do not assume frictionless flows. They price in risk, and that changes the urgency calculus instantly. The calendar is the catalyst. The next detail is what flips the whole setup. Because a market can tolerate tightness when time is abundant. It cannot tolerate tightness when time is scarce. Year-end is time scarcity for finance. Delivery windows are time scarcity for commodities. Policy deadlines are time scarcity for trade flows. Combine them, and suddenly, I can always source later, stops being a comfortable assumption. So what is the conflict force trying to suppress, deny, ignore the move here? It's not a shadow villain, it's incentives. Institutions, dealers, and large participants often prefer stability. They prefer orderly markets where spreads are tight and carry is predictable. They prefer not to advertise stress because stress invites scrutiny, hoarding, and reflexive behavior. And the media prefers simple narratives. Silver is up because rates are down, or silver is down because the dollar is up. That kind of single cause story makes people feel smart, but it misses the plumbing. And if you miss the plumbing, you miss the trade. Now let's translate this into what it forces participants to do. Dealers. If volatility rises and borrow costs rise, dealers reduce balance sheet usage. That means less willingness to intermediate physical flows. That means wider spreads. That means more urgency. Industrial users, if they hear tightness, they don't gamble with production lines. They hedge and procure. They front load. That increases near-term demand. Funds, at year-end, they rebalance. If silver has had a monster run, some take profits. If they have mandates, they adjust. And if margins rise, they cut anyway. Shorts. If borrow costs rise and price breaks levels, they cover. Sometimes slowly, sometimes violently. And when they cover into thin liquidity, you get gaps. Not candles, gaps. Because liquidity thins. That's why cargo flights matters as a narrative anchor. It's a physical world manifestation of a financial world spread. It's the market saying, the clean textbook arbitrage is not clean right now. And if arbitrage is not clean, price can overshoot in both directions before it restitches. But that's not the part that matters. The part that matters is your roadmap. Because even if every mechanism I'm describing is real, you can still get smoked if you treat it like a straight line. Silver is a whip. It's a whip because it sits at the intersection of macro, liquidity, and supply chain. So you need a two-scenario lens. You need key levels, you need confirmation and invalidation, and you need a psychological shield because volatility will try to turn your brain into a casino. Here's the two-scenario frame for the next 1 to 2 weeks. Scenario 1 is the controlled pullback and retest. This is the market doing what markets do after a violent run. It tests whether buyers are real or just momentum. In this scenario, silver holds a key support zone around the mid-70s area. Not a single tick. A zone. It chops. It flushes intraday. It scares people. Then it stabilizes. In this scenario, what confirms the thesis isn't a big green candle. It's the behavior of spreads and the behavior of availability. If front month pressure stays firm relative to deferred months, if premiums stay sticky, if borrowing remains tight, if physical sourcing anecdotes don't cool off, then the retest is a setup, not a failure. The market is reloading. Scenario 2 is the continuation squeeze and gap risk. This is the market refusing to give you a polite entry. This is what happens when shorts feel trapped, when borrow costs or availability issues persist, and when thin liquidity meets forced buying. In this scenario, silver reclaims momentum, pushes back toward the low to mid-80s, and the move becomes less about should it and more about must it. Must cover, must hedge, must procure. And when those musts collide, price can jump levels without trading them cleanly. That is where retail gets emotionally manipulated the hardest, because gaps create urgency, and urgency creates bad decisions. The next detail is what flips the whole setup. So what are the concrete things to watch that separate these scenarios? First, watch the mid-70s zone as the battlefield. If price loses that zone and cannot reclaim it quickly, if it turns into resistance, that weakens the immediate squeeze narrative. It doesn't prove no shortage. It proves the paper market is dominating short-term price and risk is being delevered. In that case, you watch the next support zone below, and you respect the possibility of a deeper flush. Silver loves to overcorrect. It's part of its personality. Second, watch the behavior around the low to mid-80s as the trigger zone. That area has been a recent emotional peak. If silver pushes into that zone again and holds, especially on a week where liquidity is still thin, the probability of a reflexive move rises, not because of magic, but because of positioning. People who sold the dip feel regret. Shorts feel pressure. Momentum funds re-engage, and dealers hedge. The hedging is what turns a move into acceleration. And that acceleration is where gaps appear. Because if this one level breaks, the math changes. Third, watch for the hidden detail signals. Any persistent sign that physical availability is tight relative to paper. That can show up as location premiums, as unusual logistics decisions, as refinery bottlenecks, as borrowing tightness, as delays, as retail and wholesale premiums staying elevated even when spot dips. Again, you don't need to worship one data point. You're looking for a cluster. A cluster is a message. Fourth, watch macro crosswinds, but don't let them hypnotize you. Rates, the dollar, inflation expectations, these matter. Silver can behave like a high beta macro asset. But in a physical stress episode, silver can decouple temporarily. That decoupling is what confuses people and creates opportunity for the disciplined. You want to know whether a dollar rally is actually cooling physical demand or just slamming paper positions. The tape can mislead, the plumbing is slower, but it's often truer. Now let's talk about the emotional manipulation piece, because if you're going to survive silver, you need this shield. Volatility is not just a statistic, it's a psychological weapon. It turns your brain into a prediction machine that wants certainty. It makes you anchor to recent pain, it makes you chase recent pleasure, and silver will punish both. Here are the traps you must expect in the next 2 weeks. Trap 1, the "this proves it" candle. A big green day will make you feel like the move is guaranteed. It isn't. It might be forced covering. It might be gamma hedging. It might be thin liquidity. You need confirmation, not adrenaline. Trap 2, the "this is over" flush. A big red day will make you feel like you were wrong. You might not be wrong. You might be early. You might be right about the mechanism, but wrong about the timing. In leveraged markets, timing is the trade. That's why scenario framing matters. Trap 3, headline hijacking. A story about rates, a story about a central bank, a story about some political flare-up. Those headlines can move paper fast. But the physical reality often moves on procurement cycles and delivery clocks. If you let headlines dictate your conviction without checking the mechanism, you become exit liquidity for smarter participants. And that's where the real pressure starts. Your shield is simple. Separate trend signal from noise. Trend signal is the persistence of tightness indicators, the behavior of spreads, the inability of price to stay down when paper slams it, and the presence of real-world urgency. Noise is the day-to-day volatility, the margin-driven flushes, the algorithmic spikes, the week where everyone is out of the office and liquidity is thin. Respect noise. Don't worship it. Now, let's address the skepticism directly because it's healthy. There are counterpoints here. There are uncertainties. This isn't a fairy tale. Counterpoint 1, a sharp rally into the mid-80s can bring supply out. Holders who are waiting might sell. Scrap flow can increase. Some industrial demand can pause if buyers expect a better price. Tightness can ease. That's real. Counterpoint 2, a year-end spike can be exaggerated by thin liquidity. January can bring liquidity back and calm the tape. That's real. Counterpoint 3, policy chatter can be misunderstood or delayed, and trade flows can adjust in ways the market doesn't anticipate. That's real. So you're not betting on certainty. You're tracking pressures and watching whether they relieve. The market will tell you. But only if you're watching the right scoreboard. And the right scoreboard is not just spot. It's the behavior of immediacy, the behavior of availability, the behavior of forced participants. If air freight chatter fades, if premiums compress, if borrowing becomes easy again, if the curve relaxes, those are signs the physical stress is easing. That doesn't mean silver collapses. It means the shortage narrative is losing its edge. And your strategy should adapt. Because if this one mechanism breaks in the other direction, the math changes again. Now, let's get brutally practical. What comes next? Over the next week, you're going to see attempts to shake confidence. That's almost guaranteed. Not because someone is evil, but because liquidity is still uneven and positioning is emotional around year-end prints. Expect intraday whipsaws. Expect fake breakdowns. Expect fake breakouts. And expect social media to scream certainty at you in both directions. Your job is to stay mechanism focused. Here's your next week checklist. 1. Does silver hold the mid-70s zone on a closing basis, even if it wicks below it? If yes, the market is absorbing selling. That's constructive. 2. If silver pushes back toward the low to mid-80s, does it do so with persistent pressure, not just a one-day spike? If yes, squeeze risk rises. 3. Do signs of physical urgency remain even when spot dips? Sticky premiums, tight borrowing, unusual logistics decisions, procurement anxiety, that's the tell. Because if physical stress remains while paper dips, paper is offering a discount that cannot last forever, and that's where the real pressure starts. 4. Do you see any sign that the curve is relaxing and immediacy is no longer scarce? If the market stops paying for now, the shortage narrative loses fuel. 5. Watch the calendar triggers. The first full week of January often reveals whether year-end moves were positioning noise or structural shift. If stress persists into normal liquidity, it's harder to dismiss. Now the invalidation level, the thing that would make you stop telling yourself this story. Invalidation is not price went down. Invalidation is the combination of price failing to hold key zones and the mechanism relieving. If silver loses the mid-70s zone and cannot reclaim it, and at the same time, physical tightness indicators ease, premiums compress, borrowing becomes easy, sourcing normalizes, then the cargo flights, stress is likely fading. That doesn't mean silver can't rally later. It means this specific setup is no longer the dominant driver. And the confirmation? It's the opposite cluster. Silver holds the mid-70s zone, stress indicators persist, and any pushback toward the low to mid-80s starts to stick. In that world, you don't need to predict a moonshot. You respect the possibility of a reflexive continuation. Because forced behavior is not gentle. One more point before we close, because it's important. Even if the thesis is correct, price can whip around violently. Silver can drop hard and then rip harder. It can rally, then punish you with a flush, then rally again. That is not a sign you're cursed. It's a sign that you're in a market where leverage, hedging, and physical constraints collide. Your edge is not predicting every tick. Your edge is not letting volatility steal your plan. If you touched a part of the metals crowd that cares about mechanics, not slogans, then you already know why this matters. Silver isn't just a chart. It's a supply chain, a balance sheet, and a calendar. When you hear whispers about silver moving by air, don't treat it like gossip. Treat it like a stress flare. It means someone, somewhere, couldn't wait. And when enough participants can't wait, price stops asking for permission. So here's the quiet community call. Not a beg. Stay in the camp that watches the hidden scoreboard. The curve, the premiums, the borrow, the delivery urgency, the behavior around the mid-70s battlefield and the low to mid-80s trigger zone. Because the loudest voices will try to drag you into certainty. And certainty is how you get harvested in this market. Watch the mechanics, watch the calendar, respect the whip. And remember, if the supply chain is still vetoing the paper narrative after the first full week of January, then silver isn't just moving, it's repricing. And that's where the real pressure starts.